Quiet now, everybody. Quiet, listen to me. We're going to start a show. Now, some of you people have been with me before. You know it's going to be a tough grind. You're going to dance until your feet fall off. You're not able to stand up any longer. But we're going to have a show.
Welcome to the Pink Door Podcast. Welcome to the debate. Today, we are turning our analytical lens toward a really fascinating case study in localized real estate economics. We are looking at the February 2026 market update for Duxbury, Massachusetts.
Specifically, the 02332 zip code.
Right, the 02332 zip code. And if you look at the surface of this market, it appears to be, well, completely defying gravity. So we have a central pressing question to resolve today. Do the February 2026 numbers reveal a rapidly accelerating, highly competitive seller's market driven by intense scarcity? Or are these top-line figures a statistical mirage masking a structural cooling in buyer demand?
It is a question that requires us to really look under the hood.
Exactly. And to do that, our entire discussion today is grounded strictly in the February 2026 MLS PIN and RPR market trends, public records data for the area. For those who might not, live in the data day-to-day, MLS PIN is the regional multiple listing service, and RPR is the realtor's property resource.
Which aggregates all that listing data.
Right, it aggregates it to give us a real-time pulse on the market. From my reading of this data, I hold a position that plummeting days on market and surging median sold prices demonstrate an unequivocally strong seller's market, one that is driven by pure, unadulterated scarcity.
And I take the opposing view. I argue that a massive drop in the price of new pending listings combined with a severe disconnect between the underlying estimated property values and the headline sold prices indicate a market that is actually softening significantly for the typical buyer. The headline numbers look like a boom, but the underlying mechanics tell a story of caution.
Let me lay out the foundation of my perspective because the immediate performance metrics we are seeing in Duxbury are honestly nothing short of staggering. When we evaluate market health, the most fundamental economic principle we rely on is supply and demand. Currently, the months of supply of inventory in Duxbury has plummeted by nearly 27%.
Month over month.
Month over month, yes. We are sitting at a mere 1.56 months of supply.
Which is incredibly tight.
It is beyond tight. For context, just a quick layperson definition, if not a single new home was listed starting today, 1.56 months is exactly how long it would take for Duxbury to completely run out of houses to sell. A balanced market where neither buyers nor sellers have a distinct advantage typically sits around 4 to 6 months of inventory. So at 1.5 months, we are looking at severe structural scarcity. But it is not just the lack of inventory. It is the sheer velocity at which the available inventory is being consumed.
The velocity is certainly a key piece of the puzzle here.
The median days on market dropped by roughly 44% month over month to an astonishingly brief 10 days.
Wow, 10 days.
Right. Think about what that means in the real world. A property hits the market on a Thursday, hosts an open house over the weekend, and by the following Tuesday, it is under agreement. Properties are getting listed, toured, and put under contract in roughly a week and a half.
Yeah, that is fast.
Furthermore, the sold-to-list price ratio remains incredibly robust at 98.4%. When you combine this relentless velocity with a median sold price that just leaped over 49% in a single month to $1.82 million, the conclusion is inescapable. Buyers are aggressively competing for a highly constrained pool of prime real estate, and they are willing to pay a massive premium to secure it. This is the very definition of a fierce, accelerating seller's market.
I come at it from a different way. The headline numbers you just cited are certainly flashy. I mean, a $1.82 million median sold price is going to grab anyone's attention.
Sure.
But those numbers represent statistical noise, heavily skewed by luxury outliers. If we look closely at the underlying data, it tells a very different story, a story that actually demands significant caution from anyone navigating this market.
How so? The $1.82 million is a factual record of what closed.
True, but the most glaring discrepancy in this entire data set is the gap between what properties are supposedly worth across the whole market and what happened to sell in this specific 28-day window. While the median sold price hit $1.82 million, the median estimated property value for the entire Duxbury market is only $1.15 million.
Okay.
That baseline valuation represents only a modest 3.7% increase over the last 12 months.
But estimated values are just algorithms.
Furthermore, if you want to know where the market is going next, you cannot look at closed sales. Those are looking in the rearview mirror.
So what are you looking at?
You have to look at the ultimate leading indicator, which is the new pending listings. The median list price for properties that newly went under contract absolutely crashed. It dropped by just over 50% month over month, down to $1.09 million.
That is a big drop.
It is a violent swing. It tells me the next wave of closed sales will be drastically lower, proving that the $1.8 million figure is a momentary anomaly, not the new standard for the market.
I see why you think that, but let me give you a different perspective on that price escalation versus the value disconnect. You are pointing to the median estimated property value of roughly $1.15 million as the true market, but as we just touched on, estimated values are generated by automated valuation models, or AVMs. They are theoretical calculations trying to guess what a house might be worth based on aggregate trends.
They are theoretical, yes, but they serve as a necessary control group.
I understand using them as a baseline, but the median sold price of $1.82 million is not theoretical. Those are actual dollars changing hands at a closing table. In fact, if you look at the sold public records data in the report, which includes off-market transactions that never even hit the MLS, the median sold price is actually even higher. It is $1.85 million. That represents an almost 61% month-over-month increase. When the median sold price outpaces the baseline algorithm's valuation by roughly $700,000, I simply do not see that as mere statistical noise.
But you have to acknowledge the mix of what is selling.
Even if the mix of homes sold leaned heavily toward the luxury tier this month, the fact remains that there is enough high-end demand in Duxbury to consume that inventory instantly. Buyers are not hesitating, they are not waiting for interest rates to drop, they are fully capitalized and absorbing multi-million-dollar properties at a rapid clip.
Right.
That speaks to immense buyer willingness to pay top dollar, which is the hallmark of a booming market.
That is a compelling argument regarding the capitalization of buyers at the top end, but have you considered the concept of compositional bias in statistics?
Walk me through how you're applying it here.
Let's use an analogy. Imagine a local car dealership that usually sells mid-size family sedans, say Honda Civics. But this month, by some fluke, they only managed to sell 3 high-end Ferraris. If you look at the spreadsheet at the end of the month, the median sold price of a car at that dealership just skyrocketed.
Sure.
But it doesn't mean the value of a Honda Civic just went up by $250,000. It just means the mix of what sold was completely different. That is exactly what we are seeing in Duxbury's luxury market.
So you are saying the $1.8 million is just a Ferrari month?
Exactly. A median sold price simply finds the middle value of the specific homes that happen to hand over keys in February. If in a given month only oceanfront estates or massive new builds happen to close, your median sold price will skyrocket. It doesn't mean the value of a typical 3-bedroom colonial inland suddenly went up by $700,000.
I hear you.
This is exactly why the median estimated property value metric is so crucial. RPR calculates that figure by applying its valuation model to the entire housing stock of the zip code. It acts as a control group against the volatility of monthly transaction mixes.
But algorithms lag behind real-time market shifts.
They smooth out the noise. The fact that the baseline estimated value only grew by 3.7% over the last 12 months proves my point. The broad market is stable, perhaps slightly sluggish in its growth compared to previous boom years. The 1.82 million figure is not broad market appreciation. It is a textbook example of a mix shift. Using a mix shift to claim the entire market is experiencing a fierce, accelerating boom is fundamentally misreading the mechanics of the data.
That is an interesting point. And the car dealership analogy certainly clarifies the concept of compositional bias, though I would frame the overall market health quite differently. Even if we can see that compositional bias plays a significant role in the monthly median sold price, you cannot explain away the velocity metrics using that same logic. Let's look at the speed of consumption.
I agree velocity is important, but it has to be contextualized.
The context is that the market is clearing properties in a median of 10 days. That is nearly a 45% drop in time on market from the previous month. If this were a softening market or a market where buyers were exhausted and pushing back on high prices, we would see days on market expanding. Properties would linger.
Right.
You would see open houses sitting empty on the second and third weekends. Instead, they are being snapped up almost immediately.
10 days is fast. There is no denying that.
Exactly. Furthermore, look at the sold-to-list price percentage. It didn't drop. It actually ticked up slightly to 98.4%. Buyers are not succeeding in negotiating massive discounts. Sellers hold all the leverage because inventory is at 1.56 months. Scarcity is the primary engine of pricing power.
Mm-hmm.
When supply is this restricted and properties are evaporating in a week and a half, the structural reality is a seller's market, regardless of which specific price tier is dominating the closing table in a given month. The Ferraris are selling just as fast as the Civics would.
I am not convinced by that line of reasoning because you are focusing almost exclusively on the month-over-month volatility while ignoring the broader year-over-year reality.
Year-over-year data in February can be tricky, though.
It can be, but it is essential. Yes, the month-over-month drop in inventory to 1.56 months looks incredibly dramatic, but we have to remember the historical context of a coastal New England town like Duxbury. February is historically a highly volatile transition month as the market shakes off the winter lull and starts gearing up for the spring market.
Fair point.
If we zoom out and look at the 12-month change metric for the month's supply of inventory, it is actually up 11.4% year over year.
But 11.4% of a tiny number is still a tiny number.
It is, but it is the direction of the trend that matters. That is a critical data point. It means that compared to this exact time last year, the market is slowly but surely accumulating more inventory. The supply constraint, while still tight by historical standards, is easing. It is loosening its grip.
I wouldn't call 1.56 months a loosened grip.
It is loosening relative to where it was. When you combine an 11.4% year-over-year increase in inventory with a baseline estimated value that is only creeping up at 3.7% annually, you do not have the profile of a market that is accelerating into a frenzy. You have a market that is plateauing, catching its breath, and slowly returning to a more normalized equilibrium.
I must push back on the idea that an 11.4% year-over-year increase in supply indicates a plateau, because we have to look at the absolute numbers on the ground. As I said, an 11.4% increase on a baseline of virtually nothing is still virtually nothing. Moving from, say, 1.4 months of supply to 1.56 months of supply does not materially change the negotiating dynamic for a buyer walking into an open house on a Sunday.
Yeah, but
It is still a profoundly constrained environment where the seller holds the cards.
the seller holds the cards if the buyer is willing to play the game. But what if the buyer walks away?
But the data shows they aren't walking away. And if you want to look at forward-looking indicators of seller confidence and market trajectory, we must examine the active listings data. The median list price for active listings in February hit $1.46 million. That is an over 25% increase month over month.
Mm-hmm.
Sellers and their listing agents are looking at the landscape, they are evaluating the buyer demand, and they are confidently setting a higher pricing floor.
Or they're overplaying their hand.
I don't think so. They are not retreating. They are looking at the 10 days on market. They're looking at the 98.4% sold to list ratio, and they see those $1.82 million closed sales. They are pricing their new inventory accordingly because they know the demand is there. This demonstrates a market where the pricing power remains firmly entrenched on the supply side.
I'm sorry, but I just don't buy that interpretation of the active listings. Let me tell you why. You are using active listings as a proxy for market health, but active listings merely represent what sellers want.
It represents market confidence.
It represents seller aspiration, not market reality. Anyone could put a sign in their yard and ask for $1.5 million. That doesn't mean the market will bear it. If you want to know what the market is actually willing to bear today, right now, you have to look at the pending listings data. This is the ultimate leading indicator because a pending listing represents the actual meeting of the minds between buyers and sellers. It is a signed contract, and the data here is a massive red flag for your thesis.
You are referring to the drop in the pending median price.
Not just a drop, a cliff. The median list price for new pending listings absolutely plummeted by over 50% month over month, down to $1.09 million. Even the overall pending listings median price dropped by roughly 11% to $1.24 million. When I first saw that 50% drop, I had to double-check the spreadsheet. You rarely see a structural recalibration happen that quickly in real estate.
It is a steep drop, certainly.
It is a violent swing. What this tells us is that while sellers are ambitiously throwing their nets out at the $1.46 million mark, actual market consumption, the properties that buyers are successfully putting under contract, is shifting rapidly toward the lower price tiers. It is settling right back down near that $1.15 million estimated property value we talked about earlier. We are watching a real-time standoff.
A standoff?
Yes. The buyers for the $1.8 million homes have either satiated their demand or they have stepped back from the market. The high-end pipeline is emptying out. When your active median is $1.46 million, but your new pending median is $1.09 million, that is a severe divergence. It indicates that the aspirational pricing of sellers is colliding head-on with the strict limits of buyer affordability. Buyers are aggressively holding the line at $1.1 million.
That divergence between active and pending median prices is a fair observation, and it is definitely the most striking tension in the report. But I interpret its meaning quite differently. A drop in the median price of new pending listings does not inherently mean buyer demand is collapsing across the board. It often simply reflects the seasonal introduction of different inventory types.
Seasonal variations don't usually cut a median price in half in 28 days.
They can in a highly stratified market like Duxbury. Think about the life cycle of New England real estate. In the dead of winter, the very few properties that transact tend to be unique, highly desirable luxury properties where buyers are relatively immune to interest rate fluctuations or seasonal timing. Cash buyers hunting for estates don't care if there's snow on the ground.
That is true.
As we move toward the spring market in February and March, more traditional mid-tier family homes finally enter the market.
Which pulls the median down.
Exactly. It naturally brings the median pending price down toward the historical average. This does not indicate a softening market. It indicates a broadening market. The middle tier is waking up, and the crucial piece of evidence supporting this is the velocity. The fact that these new pending listings are still being absorbed with a median time on market of just 10 days shows that buyer appetite is voracious across all price points.
But they are only voracious at that lower price point.
If the market were truly softening in a structural way, we wouldn't just see the median price drop. We would see the days on market spike as those lower-priced homes sat unpurchased while buyers haggled or waiting for rate cuts. But they aren't sitting. They are being consumed instantly. The underlying engine of this market's scarcity remains the dominant force, whether the house is 1.8 million or 1.1 million.
I agree that seasonality plays a role in inventory mix. Spring brings out the traditional family homes, but I have to reiterate, a 50% month-over-month drop in the new pending median is just too violent a swing to dismiss as routine seasonal variation. That is a structural recalibration.
Even with the 10 days on market?
Yes, because if the market were as uniformly robust and unhinged as you suggest, the sold-to-list price ratio would reflect higher over-ask bidding wars. A 98.4% sold-to-list ratio is healthy, certainly, but let's be precise about what it means. The median home is still selling slightly below the asking price. In a true, unbridled buying frenzy, that number routinely exceeds 100%. You see 102, 105%, as buyers waive contingencies and escalate offers just to get a foot in the door.
We did see some of that in previous years.
Exactly. But we aren't seeing that broad-based escalation here in February 2026. Instead, we are seeing a market that has hit a ceiling of affordability. Buyers will act quickly, which explains your 10 days on market. But they are highly selective, and more importantly, they are capping their bids. They are not writing blank checks anymore.
So how do you explain the year-over-year inventory rise in this context?
The 11.4% year-over-year rise in inventory is the slow, steady accumulation of properties that failed to recognize this shifting dynamic. The sellers who price ambitiously at that $1.46 million active median, completely ignoring the fact that actual consumption has dropped to the $1.09 million pending median, are the ones who are going to be left sitting. They are the ones who will eventually have to reduce their prices or pull their listings altogether, causing that inventory metric to climb even higher in the coming months.
It is a fascinating standoff between seller aspiration and buyer limits. I think we have thoroughly unpacked the nuances here. To summarize my position, in light of our discussion, while the specific price points of closed sales may fluctuate month over month due to the mix of inventory, whether it is Ferraris or Civics, the undeniable scarcity of 1.56 months of inventory and the rapid buyer action resulting in just 10 days on market fundamentally define a robust seller's market in Duxbury.
The scarcity is real, but its impact is changing.
I believe the impact remains profound. The fact that the median sold price achieved a staggering $1.82 million proves that when premium inventory becomes available, there is immense liquidity and buyer enthusiasm ready to absorb it immediately. The structural constraints of supply continue to provide sellers with significant leverage, and the market velocity proves buyers are still more than willing to compete.
And to summarize my perspective, the headline sold price you are pointing to is a lagging indicator that is currently masking the true trajectory of the market. The massive drop in the median price of new pending listings down to $1.09 million perfectly aligns with the broad market's median estimated property value of roughly $1.15 million.
The reversion to the algorithm's mean.
Precisely. This alignment proves that the $1.8 million sold figure was a statistical anomaly driven by compositional bias, not a new permanent pricing floor for the town. When we combine this leading indicator of plummeting pending prices with the steady year-over-year rise in inventory, it urges serious caution. The market is softening for the typical buyer. Treating the February luxury anomaly as a continuing unbridled boom is a misinterpretation of the underlying data.
Despite our different interpretations of the trajectory and the leading indicators, I believe we can both acknowledge that Duxbury clearly remains a highly desirable market. The overall supply remains historically limited regardless of the year-over-year uptick, and properties that are priced correctly relative to their specific tier are moving with incredible efficiency.
Absolutely. The fundamental desirability of the 02332 zip code is not in question here. Coastal real estate with strong community fundamentals will always have a baseline of demand. Where we maintain our disagreement is entirely on the current trajectory of pricing power and the broader health of the market as we look forward into the spring.
It really goes to show how complex localized real estate data can be. It requires us to look far past the flashy headline numbers and carefully dissect the leading versus lagging indicators to fully understand the shifting dynamics of supply and demand. There's certainly much more to explore within the underlying property tiers in this material.
There is always more beneath the surface. Understanding the tension between what sellers want and what buyers can actually afford is the key to reading any market shift.
Well said. As always, we leave it to you, the listener, to weigh the evidence, consider the different perspectives on the data, and form your own conclusion about where the market is heading next. If you have any questions about this episode, or if you are thinking about buying or selling a home anywhere on Boston's South Shore, from Southie to Sagamore, give Jim Aldred a call. He would love to speak with you. Jim believes that people in transition often feel anxious about buying or selling a home, and he provides them with the guidance and security to help your family move on smoothly. Thanks for listening, and catch you on the next episode of the Pink Door Podcast.
you.